If you're looking for an SBA loan and maybe your lender has mentioned something called the debt service coverage ratio, or DSCR, and you're kind of scratching your head wondering, what does this even mean? What do I do with debt service coverage ratio? How's that calculated? And how do I impact that? They're saying that maybe our debt service coverage ratio isn't going to be good enough or something in our loan request, and somehow that's impacting the loan request, and you're trying to figure out what that means, right? That's what I'm hoping to answer here for you and help walk you through these buzzwords that you'll probably find in the SBA process. The debt service coverage ratio is your net operating income divided by your debt service, and this is usually would be measured on an annual basis. And so your net operating income is similar, close to, not quite, your net income, and then your debt service is essentially what you have to pay in principal and interest payments for the year. And so your lenders and the SBA typically will have a debt service coverage ratio requirement. And a lot of times that's 1.25 or 1.25 to 1. And what that means is that they want you to have $1.25 worth of net operating income for every dollar of debt service that you'd have to pay for the year. And I have our acquisition financial projection template pulled up here, and I'm going to use that to kind of demonstrate this to you and show you how you can see what your debt service coverage ratio is and how you can change that based on pulling different levers in your business. And so what we can see here in this key ratio box, we see our debt service coverage ratio, and this is our projected debt service coverage ratio. So when you are applying for a loan, let's say you're looking to acquire a business with an SBA loan, the first thing the lender is probably going to do is look back at the historical financials of the business. And so let's say for simple math here, you're going to have $125,000 worth of net operating income, or that's what the business had in the past, $125,000 of net operating income per year. If that's the case, then what you can afford to keep a 1.25 to 1, you can afford debt service of $100,000 per year, right? And that would mean you'd have a 1.25 to 1 ratio. If you can only afford $100,000 in debt service, that kind of limits how much you can borrow, or that's going to be a parameter on how much you can borrow from the bank. And if you wanted to borrow $5 million to buy this business, and probably based on those terms, your annual debt service would be a lot more than $100,000. That's where that debt service coverage ratio conversation is going to come into play, and the bank's going to say, yep, you can't afford it. The deal doesn't cash flow. And they're going to look at that based on historic first. So they're going to say, what did the business do in the past in terms of net operating income? And, what do we think it can do? I guess they'll look in the past before they start going down the path of what do we think it can do in the future. So if based on the loan amount that you want and the historic financials of the business, if your debt service coverage ratio is not 1.25 to 1, if it's not high enough, that's where projections are likely to come in. So now you're going to need to say, okay, we are going to make changes to the business. And so we think we are going to increase our net operating income. So we think we can afford this debt service. And so that's where you're going to need to create a set of projections and make the case that you believe you can meet that debt service coverage ratio. So let me show you. I'm going to move out of the way here. And so what we'll look at here is this row right here. Now, what we have in this model, it allows you to put in the historical financials of the existing business. So let's say we've got, maybe it's a restaurant, we've got food and alcohol revenue here, historical, and then we can apply increases or decrease to that to project our future revenue. Okay. And so let's just say we are going to add, let's say it's a bar or a brewery or something, right? Because there's alcohol revenues, a significant portion here of the business. So let's say we're going to add a new wholesale partner. We're going to start distributing our beer as well. And so we think this is actually going to grow this line of revenue by 50% in that first year. Okay. And so we increase this by 50%. We come back to our at a glance tab, and now all of a sudden our debt service coverage ratio is well above that 1.25 level. So again, what your challenge is as maybe the business owner, the one that's looking to get the loan, whether that's for an acquisition or you're trying to get a loan to expand the business and you think that expansion is going to help you increase revenue, you need to show in your projections how that increase in revenue and profitability ultimately is going to allow you to meet that debt service coverage ratio. What I would suggest, if you're having trouble with this conversation and your banker saying, the deal doesn't cash flow, what you need to do is you need to get your financials into a format like this, where you've got your historical financials, and then you're saying, okay, after I get the loan or after I make the acquisition, here's how I'm going to increase my revenue. Or on the expense side, we do a similar thing. You can have your expenses and you can increase or decrease those expenses, based on your plans. And then from there, you're going to come back and you're going to look at, okay, once I made those changes to the business, how did my debt service coverage ratio look? You can also, if you want to see, what your net operating income is, this line right here is going to show you your net operating income. And remember, to get your debt service coverage ratio, it's a net operating income divided by debt service. If you want to see your debt service on an annual basis, you can look at your cash flow statement. So I'm going to zoom in here. So let's just look at this year 2 cash flow statement. We've got cash paid on loan principal of $67,000 and cash paid for loan interest of $70,000. So those two items right there, that's your debt service for the year. If you add those two together, that's your debt service. You need to make sure your net operating income is 1.25 times that amount. So another way to improve your debt service coverage ratio would be to reduce your debt service. You could lower the loan amount, you could extend the term of the loan amount, you could lower the interest rate of the loan amount. All of those things would help reduce your annual debt service and improve that ratio. So hope that's been helpful. We're going to put a link to this acquisition template in the description of the video below. We also have 100 plus different financial projection templates that will help you create projections for really any type of industry or business. We'll put a link to all of our templates down in the description of the video below, so you can go check those out and create a set of projections for your loan request. If you have any questions about that, please don't hesitate to reach out to us at support@projectionhub.com. Thanks.